I would like to get started. And so I will start by welcoming everyone. My name is Amy Krupel. I'm the director of the UF Center for European Studies at the University of Florida. Our center is a Jean Monnet Center of Excellence, as well as a Title VI National Resource Center for Europe. We have just a few housekeeping tips before we begin, just so that everyone understands it and is aware of it. Our discussion today is recorded, and the recording will be available on the CES website. We will have a question and answer session following the presentation, and you can partake in that by looking at the bottom of your screen for the Q&A, and you can simply type your question there. I want to thank everyone for joining us this evening. We are discussing risks and returns in peer-to-peer lending, comparing European fintech platforms. This talk is part of a larger series, European Studies Because, which examines manifestations of European studies in fields that are not traditionally associated with European studies. And we are very pleased to welcome our speaker today. She was supposed to join us live last spring. We appreciate your flexibility and your willingness to transition to this platform. Our speaker is Dr. Sophia Johann, who is an assistant professor of finance and a fellow of the Phil Smith Center for Free Enterprise at Florida Atlantic University. She is also chair in entrepreneurial finance at the University of Aberdeen Business School and the extramural research fellow at the Tilburg Law and Economics Center in the Netherlands. She is associate editor of the British Journal of Management, serves on the editorial board of Finance Research Letters, and will be co-editor of Venture Capital and International Journal of Entrepreneurial Finance beginning in January of 2021. Her research is focused on law and finance, sovereign wealth, market surveillance, corporate governance, alternative investments, and alternative finance, as well as peer-to-peer lending and cryptocurrencies. And she has published research in a myriad of journals, to name a few: American Law and Economic Review, the Journal of Financial Economics, the Journal of Banking and Finance, European Economic Review. I could go on and on. And she has also authored or co-authored several books, including Crowdfunding, Fundamental Cases, Facts and Insights, Venture Capital and Private Equity Contracting, an International Perspective. She's also co-editor of the Handbook of IPOs published by Oxford University Press, and is working on another handbook on hedge funds, also to be published by Oxford University Press. In addition to all of this, she has consulted for a variety of governmental and private organizations in Canada, in Australasia, and in Europe, and sits on the advisory board of a select few startup firms. Helping to moderate today's discussion is James Ruffer, who is the co-founder of Web3 Devs. James is a blockchain developer and fintech expert, and he has deployed blockchain peer-to-peer solutions throughout the Caribbean and Latin America since 2016, and is infinitely more qualified to engage on the subject than I am. So I want to thank James also for agreeing to be with us this evening to help with the moderation of this discussion. I don't want to take up much more time. I'm going to hand the discussion over to Dr. Johann. I would remind everyone that at the end of the talk, you will be automatically sent to a survey as you try to leave the talk. We very much appreciate your participation in that survey. It helps us to understand better what interested you in the talk, what other talks we might be able to give, and how you found out about the talk. So if you could take a few minutes to complete that when the talk is over, we would appreciate it. So with that, Dr. Johann, I'm going to mute and disappear.
Thank you very much, Amy, and thank you, Carla, for inviting me for this. I've been very interested in the work that the center has been doing, and I really appreciate this invitation. So, as you know, Amy made it sound like I've been very busy, but my area of research is originally started in the area of law and finance. So I look at how changes in regulations and laws affect the economy, affect financial markets. And I have a background in venture capital. That's the reason my main area of research also is in venture capital. So I started out, I'm legally trained. So I did my law degrees in England. I did my master's in international economic law in England, where I spent a couple of years learning about the trade treaties, very boring. And then, and I did my PhD in international, I did my PhD in law and finance at the Tilburg in the Netherlands. But, you know, I was a venture capitalist initially, and I've always wondered about, you know, sort of the theory behind what I was doing at work. We were investing in very early stage companies. And you know, we were fund of fund managers. We were our direct managers, and that sort of led me to the interest in studying this area of venture capital. So upon doing that, you know, looking at alternative and investments, sort of path dependency, my area of research is now going into the areas of alternative finance. So, you know, just as I've always been interested in looking at how startup companies are funded by venture capitalists, how venture capitalists can succeed, how young startup companies can succeed with venture capital investment. You know, and that sort of evolved into crowdfunding, equity crowdfunding, and you know, that's all now evolving into peer-to-peer lending. So that is the area that I am going to start talking about today: peer-to-peer lending. You know, I do work. I do work both with U.S. data and with international data, especially European data. As I said before, because that's where I worked initially, and that's where you know, it's interesting to compare the different markets, you know, in Europe and both in the US, because while there are significant differences, there are also huge similarities, and you know, we'll discuss that as we go along. So I will share my screen first, and this is essentially the research that I am carrying out with my colleagues. I hope you can see the screen. It's always iffy whether I'm able to share this. But so this is work I've been carrying out with Saman and Gianfranco. Thanks, James. So Saman is from Vienna and Gianfranco is at EDHEC. And you know, we started working on this because we have a joint interest in alternative finance. So if you're familiar with the areas of finance, alternative investments are, you know, venture capital investments, sort of, you know, investments that aren't highly correlated with the stock markets or the bond market. So you've got hedge funds, you've got private equity, you've got venture capital, you've got real estate, you've got real estate investment trusts. So those are alternative investments. Alternative finance is just sort of what they consider to be either the new forms of finance that you could say are substitutes for the alternative, for the traditional financing that companies get, either through bonds or through the bank debt. So alternative finance is, you're looking at crowdfunding, you're looking at equity crowdfunding, you're looking at donation crowdfunding, you're looking at crowd lending. So what we're looking here today is peer-to-peer lending, which is, and we'll go into that. So as Amy mentioned, I'm currently working with at Florida Atlantic University. I also do research for the Dutch Institute, which is the Tilburg Law and Economics Center, and I'm also working with the University of Aberdeen in Scotland. Not physically, because that's impossible, but it's still a great organization. So what is peer-to-peer lending? If you're familiar with crowdfunding, it's where you've got you go on a portal and you decide to donate a goat to a village somewhere. So that's donation crowdfunding. Or you've got the GoFundMe that you hear often in the news, where somebody has a project and would like funding from the general public. So you go on a portal and there you have it. You provide funds for these projects. So, there's funding where you actually have rewards based, where, for example, you have, for you fund let's say a band who wants to create an album, and in return for the $100 that you fund them, you're getting back, an album. So that's reward based. Now, once we started being very familiar with crowdfunding donation and crowdfunding as in reward-based crowdfunding, many people were realizing, especially when if you recall, the Oculus goggles, right? The Oculus virtual reality headwear, when that received crowdfunding, and based on the success of their crowdfunding exercise, they were able to sell themselves to Google, and they were able to raise a lot of money, and so the crowdfunders who helped this project were saying, wait a minute, why are we just only getting the product when we could actually, because of our help, we could actually gain on the upside of their equity share. So that's how equity crowdfunding started. So you're investing in small startup companies, very familiar to what venture capitalists are doing. So, but instead of experts and expert accredited investors such as venture capitalists investing in small companies, you've got retail investors, you and I, who go online, and we through a portal, we identify these companies that would we think be successful, and what we think we can identify as future potential, and we invest in them in return for equity. So that's only been recently allowed in many countries. Of course, it started out in Europe. It was very well known and established in Europe and Australia, and then with the Jobs Act, it became legal here. Not necessarily as popular as you think it would be based on the restrictions, but it's still possible. So when that, in line with this, at around the same time, you also have what you call crowd lending, which is, instead of investing in a company or getting giving products in return for cash, you, through a portal, raise funds for your projects. So for example, here you've got the crowd lending platform. You've got the businesses or the people who are looking for a loan, a short-term loan, and you apply to the platform, and then there are institutions and there are retail investors who decide, hey, for a 10% return or 7% return as promised, why don't I just lend it to this person? So, it's in different countries, you have different systems. So, for example, I have a paper looking at peer-to-peer lending in the U.S. In the U.S., the largest platforms are, you're looking at you're looking at like, if you're familiar with Quicken Loans, Rocket Mortgage is one of those platforms. You've got, you've got Prosper. You've got very, very large platforms that do this, and but you have to, in certain states, go through regulated banks to provide this funding. Whereas in other countries, like in certain countries in Europe, you would be able to directly supply the funds to the borrowers. So it's slightly different. And that's one of the reasons why we wanted to look at the European markets. Now, this is a very preliminary research. We don't have a lot of details on the mechanics of each country, but we're still trying to get that data. But we do have enough information from sufficiently a large number of crowd lending platforms to be able to, have some interesting findings. So, if you're looking at crowd lending, you can also consider as fintech. So these are the terms that are commonly used. Fintech is very popular now, where you've got, for example, a lot of these online mortgage providers that are using banks as conduits, and for example, Bank of America, a lot of these banks are now creating their own fintech units because people realize that it is much more efficient to borrow money online through a platform. There's research that finds that there's I suppose it's because the applicant is sort of invisible, or there's less when you talk about, how shall I say it, it's more democratized, and there's less discrimination. So it's much easier for those who generally had problems getting funding before to get it now. So there's more research about that. So you've got consumer loans, consumer lending. That would be, for example, if you want to buy a car, medical bills. If you want to, you consolidate your loans. They're smaller loans. You're looking at in Europe, about 200 euros to about 20,000 euros. So it's more for smaller expenses. You've got business loans where companies are borrowing money. So it's like raising a bond. So that goes about 50,000 to about 1 million, and you've got larger loans, real estate loans. They go up to about 5 million euros. So this is a market that isn't necessarily small. This isn't, this isn't, providing a well to a village or, donating a cow. We're looking at significant amounts of funds. There's a lot of interest by institutions, and it's not just retail investors. Institutions themselves are really interested in this area because of the potential for huge returns. So that's generally why we wanted to look at this. And also, the research finds, you've got the Cambridge Center of Alternative Finance. They're looking at, when it started many years ago, crowd lending started in the UK about 2005. So, many years ago, you're looking at about 1.2 billion in transactions. Now up to 2016, it got up to about 16 billion. And then you're looking at a value of, we're looking at 38 billion in 2023. So it's grown significantly. The market and I suppose around the world, of course, it's much larger. Generally China's one of the largest crowd lending markets. Then it would be Europe, and then the US. So the data between Europe and the US, it's still it's unclear. There's different data that shows the sizes, but what we were interested in, at first was like, okay, so we know this is a market, we know there are risks, but we wanted to see whether these risks are like traditional financial markets, whether they're priced in appropriately. Remember, when you consider investing in investments like stocks and mutual funds and bonds, it's very clear that you get significant amounts of information sort of influencing you with regards to your expected rate of return, and sort of risk factors that you can consider. When you're looking at investments such as hedge funds and venture capital funds, you're investing in sophisticated investors that will generally indicate what rates of returns you would expect from investing in them. Now, with equity with crowdfunding platforms or crowd lending, you still have you do have the platform sort of indicating your levels of expected return. So data will tell you that you're looking at about 4 to 10% for some platforms, and then you're looking at up to 20% returns from other platforms. So we wanted to know whether these platforms were pretty much pricing their investments, the risks within these investments appropriately. Because remember, these are investments made by retail investors, and especially in areas like P2P lending, in areas such as crowdfunding, it's still rather new. So what regulators have had to do is sort of adapt their existing regulations that cover securities and other trading methods to crowdfunding. And sometimes that doesn't necessarily translate as well. So for example, let's say if you take the US, some states don't allow crowd lending, some states do. Some states will allow it to a certain extent. But then those crowd lending platforms have to be as well regulated, as well licensed as as a normal bank. So that defeats the purpose. Whereas in Europe, it's clearer. It's allowed in these jurisdictions, and therefore that's one of the reasons also why we wanted to look at the European data. Okay, so when I teach, I tend to have spoiler alerts because that way when they do sleep, at least they're there for the first 5 minutes of the class. So just in case you're not off, generally our findings, initial findings. Remember, this is still very, very nascent research. It's interesting because the returns that are reported or suggested by the platforms they're not consistent with the levels of risk that those I suppose those securities or those lending deals would suggest. So you've got for example, you've got the risk adjusted returns are so atypical to what we would expect from normal finance theory. So if you have more importantly, it's something that we can't necessarily make sense of. But what we also find is that those platforms that tend to maybe misprice these loans tend to have larger numbers of loans transacted and volume of funding. So it worries us, especially if we're looking at the regulation or the efficient regulation, the proper regulation of these sort of instruments. It's that the platforms may be taking advantage of the information asymmetries within the market. And so if they're behaving opportunistically, this is something that is of a concern because these are retail investors that may not necessarily understand the market. So what we did was we looked at about 68 different platforms. This is the beauty of looking at European data is you're able to look at great heterogeneity, which is interesting, especially for this sort of research. And we're looking at the funds that were raised on the platforms we looked at. We're looking close to is 931 million, so not a huge amount, but still significant amounts. And we're looking at data from 2012 to 2017. We'd love to update that, but because of the information that we're getting from these platforms, it's not necessarily as easy as you would think. So we're looking at about 4,100 over crowd lending financings, right? So it's interesting. We were looking at the amounts. So on average, they're getting about close to 90,000 euros. So again, this is a significant amount of funding for the companies. The IRR, you're looking at about on average 7.7. So as we said before, we've ranged from 10. Low IRRs of 4 to 20. So on average, it's about 7.7 IRR. The maturity, you're looking at about 3.4, so about 4 years. These aren't long-term loans. These are, this is just something where you'd have a short-term sort of expectations. Most of them are senior debt, and most of them are secured. So just like traditional bonds or traditional debt provided to companies, we're only looking at businesses, not necessarily the consumer loans, because those consumer loans may not necessarily be sort of what we want to consider to be on par or equivalent to the type of funding that most normal businesses would get. And I'm just interested in the data that we can get. So, most of the financings came from France and the UK, because these are leaders. The P2P lending started in the UK. You've got Spain's has significant information, has significant presence in that. Belgium, Norway. So it's look, and all these countries also like Austria, although you're looking at maybe 1.2% of the deals, but their range of tenure is much higher. It's about 6 to 6.5 years, whereas most other countries you're looking at less than 2 years. The amount of funding raised, 348 million in the UK, down to 1.6 million in Lithuania. So the funding, it's Sweden. It's quite interesting. They're 437% of what they would reach. So their deals are getting more than what they seek, but that would depend again on the type of platforms and how they operate. Average IR, if you're in Estonia, it's great. It's 10.6. If you are in Lithuania, it's great. It's 21%. If you're in Germany, if you're in the Netherlands, it's pretty average, the returns. But that's something that we would look at in the future, just trying to figure out sort of what. But there are other research papers looking at the average returns. But we do know research finds that if you are looking for if you're doing crowd lending or you're looking for crowd lending funds, you do tend to get better rates than you would if you were to go to a bank. Mainly because it's your the cost of providing these through these platforms is much lower, right? So when we consider that, why is it popular? If you think about obtaining a loan through these crowd lending platforms, right? You also consider, they also call it marketplace lending and there's so many terms for it, but when you go to a bank, you're pretty much restricted to observables that you have, your credit rating, you have, the normal, measures of risk of providing a debt. Now, with these platforms, sometimes the information that they have, there are some platforms where you can have 1,400 different variables to measure a person's or a business's credit opportunity. So, their level of risk, it's you are able to observe many different variables that you wouldn't normally get through a bank. And so, it's that's why it makes it much easier for many people to get funding from crowd lending platforms. There's suggestion that again, they don't face any discrimination, which a lot of borrowers do with the normal traditional banks. They don't. It's a lower cost. It's just there's so many benefits to it. People are more comfortable and able to access these platforms without having to have a bank nearby. And so that's why it's proliferating. That's why it's very popular for those seeking the funds. Now, what we're worried about are those that are providing the funds and being promised certain returns. And that's why when we looked at the levels of returns promised to these lenders, and we wanted to see whether they were consistent with normal finance, traditional finance, understanding of the pricing in of risk in these assets, right? So, this is, again, preliminary so far. What we have is that it is interesting to us. So the longer the tenure of the loan, so usually and normally, if you consider the pricing in of these risks, the longer the loan, then the IRR would generally increase because you get a higher return. Now, here for this crowd lending, the longer the loan, the longer the tenure, it just seems like the IRR is decreasing. So, that was interesting to us. So which is contrary, so atypical to normal traditional debt instruments. The higher the amount usually would mean that you would have a higher IRR because it's higher risk. Now, in this case, there's no indication. We can't tell. So that's not driving it. That's number two where we thought that was interesting. When I say interesting, this is not something what we would expect. When you're looking at subordinated loans, so usually if a loan is subordinated, so it's not a senior loan, then you would generally have you would generally have higher rates. So that's normal. So, so far we've looked at two risk measures, that's atypical, or we're not able to tell. So far we've got one, which is subordinated loans, basically mean that you're going to have higher rates of return, which is normal. And then, we're looking at hybrid loans, and again, that doesn't tell us anything based on the data that we have. So it just seems like these are normally, risk measures that are priced into the loan, which aren't for crowd lending. And then more interestingly, usually secured loans would mean that your IRR is going to decrease because you're not taking on that much risk. Now, here, when you have the higher the collateral, the more secured it is, it doesn't decrease the IRR, right? So these are just sort of the initial findings, which suggest to us that, we're only looking at, it seems like there are quite a lot of crowd lending platforms that we could gather more data for that. We're looking at a general, enough European countries to suggest there is, there's heterogeneity there within our sample. But what's interesting to us is what we would expect a crowd lending platform, which generally provides the same. It's providing debt to a firm, and and like the U.S., you would be getting a bond or security in return for that cash, and the pricing would be very similar, the same structure. But from what we know, that's not happening within the crowd lending platforms, and so it suggests to us that these platforms are maybe mispricing them. Again, we're still looking at which direction, but generally they're mispricing them, which for a retail investor that may not necessarily be sufficiently sophisticated, and they think that they are going to get higher returns based on the security of these platforms. That's where we're a bit worried, because what we find is that the platforms that seem to be mispricing tend to be benefiting from the mispricing, so for us, especially because once we're just worried that as it grows in popularity all around the world, what we find from the European data, where if you think about it, these are some of probably the most sophisticated, educated people in the world. If that is happening, that's what the platforms are doing. We would want to really consider how we would avoid that problem in the future. And use that as a test case to then bring across to other countries who are including crowd lending into their portfolios. Because if you think about it in the long run, people like you and I do not have access to a lot of alternative investments. To diversify a portfolio. We've got our mutual funds, we've got our 401ks, we've got bonds, and that's pretty much it. So increasingly, many savvier retail investors are using crowd lending and equity crowdfunding to supplement their future, their portfolio for their savings and retirement. Now, if that is mispriced and they're not necessarily, they are either taking on too much risk for lower returns, then that is going to be a problem in the future, which we are very concerned about. Again, this is still very preliminary. This is just initial findings that we found very interesting, and it's the geek in us. We like the moments better than the aha moments, because that leads us to further questions. That is pretty much the crux of my research. That's our research on European data, and because peer-to-peer lending is so interesting, and because to us this is the new form of corporate finance. Companies used to go to venture capital, and then they're trying to get equity crowdfunding. But remember, if you think about the levels of bond trading versus share trading in around the world, there are 1,000 times more bonds being sold on a daily basis than shares. So if you think about crowdfunding and crowd lending in a similar vein, then crowd lending is definitely going to be the choice for many firms, for many investors, for many entrepreneurs. So, for example, I have another paper looking at levels of entrepreneurship depending on the ability for a state in the U.S. to have access to crowdfunding. Why? There are seven states in the U.S. that don't allow crowd lending. So now we're just looking at the levels of entrepreneurship in looking at the threshold at the border. So 10 miles into a state where there's no crowd lending, 10 miles out of a state where there is crowd lending. How does that affect entrepreneurial activity? And our results are really interesting. And we do find that there is more marketplace lending, there is more crowd peer-to-peer lending in states where they do allow it. More importantly, the entrepreneurial activity is increasing. That means, like a 10% increase in marketplace lending, marketplace loans increases the number of entrepreneurs per 1,000 capita by 0.44%, I believe. And more importantly, it is going towards companies that have less than 10 people as personnel, that are, companies that are in rural areas that don't have banks around them, companies that aren't high tech. So, we're looking at convenience stores. We're looking at, agricultural seed sales. So these are small companies, but you add them up, and this is the backbone of the country. And that's what so that's why we're trying to figure out whether crowd lending is pushing this. And if it is, how do we ensure that the beneficiaries, i.e. the companies or the entrepreneurs, benefit as much as the lenders, right? Because if there is a discontinuity between those two, then you're going to have a problem with the market. And that's what we're looking at. We're using European data first, because European data, this is where it all started, and there's a great amount of data available from the various countries, and then we're sort of applying what we've learned there and asking the same questions in the other countries. I think that's pretty much what I have to say, James.
That was amazing. Thank you so much for all of that. The data is intriguing to me. We do have a couple questions here. I attempted to combine a few and put them in a semi-order, so we're not over the place here. So the first one is, can you define risks? Are they just defaults, or are there other risk factors here?
They're defaults. So if the borrower can't pay back, just like any other security, you don't get your money back.
And then can you define the difference between secured and unsecured loans?
So, just like it, because if you recall, the levels of loans go up to 5 million euros. So let's say if they were creating a new production plant that needed a piece of machinery for 60,000 euros, then that would be a secured asset, just like any other bond, right? So it is just like any other bond or security, where it's secured against an asset, it's secured against an IP, it's secured against, but it's just the source of the funds is from retail investors. Usually it would be from banks, it would be from institutions, insurance companies, accredited investors. In this case, it's from people, it's like you and I. So imagine if we, had a late night out at a bar at 3 a.m. and, instead of buying buying a toaster oven online, instead of Amazoning it, we're on a portal trying to, invest the money. So that gets a bit scary.
Agreed. Do you feel that these platforms are not always following the compliance as traditional banks, allowing overextending credit loans just so they can collect higher fees and mispricing?
There's that potential, definitely, and that's why there are, especially let's say look at the U.S. In the U.S. there are some states that require the platforms to be as equally regulated, as equally licensed as a bank. There are some states that don't allow the platform to provide the cash directly. It has to go through a regulated bank. But that's in the U.S. where there's high regulation. But in other countries in the world, it's in flux, right? Because the thing here is this is so new. And I know it's not new to us because we've heard about it. We've equity crowdfunding and whatnot. But for the regulators, it's still very new. It's just pretty much like cryptocurrency, right? Nobody knows what it is. So it's the same thing as these platforms. What is it? Do they provide, are they banks or are they just like the Uber, right? Is it like the Uber model where you've got somebody who wants to ride in a car, somebody who's got a car, they meet. So these platforms can either be a platform that carries out due diligence where they verify these loans, or it could just be the Uber model or the Google model where somebody wants information, they type in the request. There is a website out there that will give you the information. They're intermediaries. So it really depends on how we see these platforms. And around the world, they're different.
Yeah. Does your research show where the unregulated platforms are they more in the EU or are they more on the United States side when it comes to maybe the decentralized and not kind of knowing, just kind of trying to follow up, like not knowing like what the regulations are, kind of like Uber did, is we're just putting two people together. We're just a platform to do that. What they do is up to them. We're just that platform. Are you seeing that? Or do you feel like they're going to start getting in trouble by having that methodology?
There's been quite a bit of research on the regulations, but the problem is the models change so quickly that the research can't keep up. From my understanding, the U.S. is very much stricter than a lot of other countries, but at the same time, that also restricts access to these funding. So it's a balance. We know that it's increasing the supply of credit to those who need it is crucial, especially at this time, right? And restricting it is, in a way, maybe not as beneficial, but when you then compare it to other cases where you've got Lending Club and all that having sort of these scandals, then you balance that with maybe it in the meantime, while we are understanding the environment, maybe it is good that it is regulated. But yes, I mean, if you think about European countries, because of, and also the ability to arbitrage, right? So if, for example, if you are in a state here, you might not necessarily be able to go to another platform in another state to get funding. In many countries, or, in many countries in Europe, you could just go to Lithuania if you wanted to. I mean, there's arbitrage opportunities, which is, also interesting to study.
Thank you. Would you consider the volatility of crypto as a risk factor?
It depends on whether the volatility is market driven, or the issue with volatility here is because nobody really knows what crypto is. It is a risk factor for those who have crypto, but that's equivalent to you saying, okay, so the money that I suppose the amount in your bank account may not be deemed legal in 3 months because crypto. I mean, if you think about it, some country like as you say, right? So in the U.S. right now, it's not currency, it's not a security, right? Whereas in other countries, it is deemed as currency. So therefore, it's secure, but currency is less regulated than securities. But at least there's certainty in knowing what it is. And that's why by saying it's property, so that it's more about barter, is it risky? Any asset is risky. But the fact that the regulators are quite slow in providing at least some form of certainty, it's either just say it's illegal, right? Instead of saying, well, we're not really sure, then at least there's some certainty. In my mind, I mean, there's a lot of research out there that suggests that it is currently being used, and there are there's methods of using it as a currency or negotiable instrument or what have you. But and I think it is the way of the future. And I think we do need some form of certainty to minimize the risks that these holders or these creators of crypto are facing.
What are the risks for peer-to-peer lenders in the US in cases of pandemics? For example, are lenders protected legally?
No, it's when you say protected legally, I mean, it's just like if you were to provide funding to any company, or if you were to lend money to anyone else, you have a right to get to being paid back. Whether that person can pay you back is a different issue altogether. So during the pandemic, I think during the pandemic there is a significant uptick in peer-to-peer lending, because it's the idea that it's first of all, you can't go to a bank and get funding now. But you want to, so you're going to a marketplace to basically raise funds. But then the problem here is, remember, the retail investors. So these retail investors, they're all hoarding cash. So it's very hard to get funded, to get the funding, unless you're willing to pay a high return. So it's just like any other marketplace. Are there risks? Yes. And is it less? It's probably more risky for you to lend it to your cousin than it would be for somebody through the portal, I would think. Because as they say, if you don't like your family, just lend them money, right? Don't tell my mother I said that, but.
Exactly. I did read in your paper, you talked a little bit about your research in scoring systems. So I'm curious, do you feel that there's going to be a standard scoring model or methodology in this peer-to-peer lending? Because you're kind of allowing people to do their own due diligence to where in a traditional, we have credit checks and other tools associated with it. Maybe it's too new, but I was just kind of curious of your opinion of whether or not we're going to see some scoring systems come soon.
There will. I'm sure there will be. It would be. I mean, it would be unentrepreneurial for anyone to not do that. I mean, it's especially because a lot of institutional investors are going into this realm, because it's easy for them because they have the funds to invest, and this is fairly safe, especially if it's small amounts. If you think, for example. The credit cards that if you don't have a great credit rating, you're going to get a credit card. Capital One will give you one. They'll give you $1,000 limit, and it's like a marketing cost, right? If you are not creditworthy enough, this is the model, right? If you're not creditworthy enough, they will give you the $1,000 limit, and if you're able to pay back, you will continue to use that card because you're not going to get another card. And if you don't pay back, what's $1,000? That's the price of marketing, and that's pretty much what is happening here. They're trying out to see whether this is an industry or a field of finance that's I suppose has potential. And the EU has always been further ahead because the regulations are centralized. They don't have to worry about state by state restrictions. So if you open up in a country, then you could easily then, under the EU system, you would just be able to operate across the EU. In the US, you have to go state by state by state, and that's very, very expensive. So that's why they're far ahead, and that's why I bet you they already have a scoring system, but I can't read French or Italian or what have you, unfortunately. It's hard to find, but it would be interesting to see how they carry out the scoring system. It's sort of like crowdfunding portals now. Crowdfunding portals, some of them do extensive due diligence, some of them don't. So you would be aware of which equity crowdfunding portals do due diligence, and they are more successful and they are more popular with the general public because it's safer. You're looking for that expertise. The idea is I want to have a curated set of borrowers. I don't want to Craigslist it. I want, Amazon to tell me these are the 5 top items for today, and this is what you buy. So that's what people are expecting, I think, right?
Agreed. Yes. In your other paper, peer-to-peer is allowing more lending in rural areas. Are you getting the lending from their own area or money coming into their area?
With the portals, it's not necessarily clear. They'd have to go through the portal in their state or the peer-to-peer market in their state, but it's very unclear where the borrowers are really from. And that's the beauty of it, right? So they are, because they are getting the lending, and it's easy for them because they don't have to rely on a bank that's close by. Because what we found was that there's research that finds that once banks were able to sort of create more branches, against the branch restriction laws, then there was higher entrepreneurship. So we wanted to see whether portal lending would lead to the same. And in fact, it did. And more importantly, these are lenders that the banks wouldn't normally want to lend to. It's for the small amount of profits they make, it may not necessarily make sense. And these are lenders that, like, it's interesting because the idea that if you go to a bank, you fill out a form, they'll check your credit rating, and that's it. They decide whether you are worthy or not. You've got portals where they can detect on your phone where you go. They know you're employed because they can check at the time of where you go from 9 o'clock in the morning until 5 p.m. They know what you're spending on. They have all this information. Like I read somewhere, there's a portal that has 14,000 data points about a person. So it doesn't really, the credit rating is irrelevant at that point, right? Especially when you know where this person is every minute of the day. Like, that is fascinating. That is the future.
That is. Do you think that the bank lending will be more dissolved due to the peer-to-peer, diluted to the peer-to-peer lending being easier and more costly for these smaller businesses or end users?
There's a huge body of research on looking at the substitution, on the complementary effect. So are peer-to-peer lenders substitutes, or are they going to be complementary? So what they find is that they're not necessarily substitutes, because if you were able to go to a bank, many people prefer to go to a bank, many businesses, because you get the sort of like the certification from bank lending. So to the public or to future lenders, you know that a bank has certified you. I mean, that's one theory. But it's more of a complementary. So these are people these are businesses that wouldn't normally find it easy to go to a bank, or find it as cheap to go to a bank. So by going through peer-to-peer lending, even if they could get a bank loan, it's cheaper for them to get it through the peer-to-peer. So I think it works both ways. Because remember, if you are supporting an entrepreneur that has less than 10 people, as that builds up, they are going to continue, either they're going to continue for a little while to have peer-to-peer funding, but they will tend to be institutionalized, and they will then go to banks. So this is a great way to build up. So this is a great way to build up the clientele for banks in a way, low risk for the banks. It's sort of like how venture capitalists will build up the companies, and then they'll take the companies public. So the venture capitalists take on all those risks, build the companies up to where other investors can take over, and Bob's your uncle, right? They just unleash these companies into the world. So that's what we're hoping, that it won't dilute the bank effect or the bank benefits to communities, but it will just accentuate or complement these banks, hopefully.
Thank you. Also, in your research, you went in a little bit of gender and race equality. You had a good example of the women lending. Were you also able to look at the bank versus unbanked users?
No, I don't have that data. Although that would be quite interesting. But it's I think Bartlett in 2019 wrote about the discrimination, how the AI is actually minimizing the discrimination. Or previously, you've got females. Although females are known to be more trustworthy and are known to pay back their loans more, but sometimes it's much harder for them to get funding. Although they tend to have less default rates. It's crazy. And then African Americans and Latinos also, there's research that finds that it is much harder for them to get loans. There's two schools of thought. They say that these portals, because you only look at information, there's no real discrimination to be carried out. Having said that, there's so much information that it is very easy to determine those factors, those same factors within 14,000 data points. You don't necessarily have to have a picture. You don't necessarily have to have a name. You already know based on the zip code, based on the, so it's, so they say that it reduces discrimination, but it could just be they are able to compartmentalize the different borrowers, but because they have so much information that they know that these borrowers are going to be credit worthy because of the additional information. So you're not reliant on looking at certain, certain demographic makeup, so to speak.
Excellent. I know we're getting closer to time here, so I'm going to fire through a couple of more of these because I don't know if we're supposed to stop exactly or over. I noticed that countries like Canada and Mexico are not listed in your crowd lending. How is crowd lending being marketed to countries not participating in it today?
I don't have data on the Mexican crowd lending. I think they do have it. I know Canada has it. Canada's got a very active equity crowdfunding market. Lots of portals, but it's just I don't have the data on that. And I have data on crowdfunding, equity crowdfunding in Canada, but not crowd lending. Haven't worked on that yet. So, but it's there. It's there, and it's very well. We worked on advising the securities regulators in ensuring that the retail investors are protected over there.
Oh, nice. Is the EU further along versus the US when it comes to the peer-to-peer platforms?
Oh yeah. and they've got very disparate. So the US platforms are large institutions. So they're larger institutions. You're looking at Prosper, you've got Lending Club. So these are large. Whereas the US, they tend to be sort of smaller. So you've got a huge diversity. And they started way earlier. Regulation-wise, it was easier to set up there. Australia is also crowdfunding way earlier.
Oh, really?
Yeah.
Is there any suggestion that the crowdfunding is used more often for sustainable businesses or leaning towards circular economy than traditional funding?
I don't have the data on that. The thing about sustainable businesses is that sometimes it's much easier for you to get funding through the traditional routes because all these funds, all these mutual funds and whatnot, they're all looking for sustainable investments. That's what their clients require. So if you have a sustainable deal project, but it's much easier for you to get traditional route financing than the crowd lending. But having said that, that doesn't preclude you from trying. I think it doesn't. The crowd lender is very different from the equity from the crowd funder. The crowd funder is looking for positive affirmation. They like being able to say, "Hey, I bought the Pebble watch. I bought the Solo stove. I'm a first mover." Whereas the crowd lender just wants the return. Right? There's no coolness factor to lending somebody money to buy a car at 10% interest. They just want the return. So it's a different type of investor. Whereas crowdfunding, everybody likes telling people, "Oh yeah, I bought the Solo stove when it was, on Kickstarter."
Agreed. And would you consider that collateral as far as someone that wants the Pebble watch, as far as they're willing to quote unquote lose or risk the more money of that not getting funded in exchange for being that first Pebble user?
Yeah, I think so. I mean, it's especially when you're investing in, especially for crowdfunding, when you decide to buy a Pebble watch, you don't know whether the levels of fraud on crowdfunding websites it's significant. The levels of non-performance is actually quite significant. But remember, these are well-regulated markets. So it's not like you can, complain about Amazon. You can't complain about something on Kickstarter because when you bought the item, it hadn't been created yet, right? So there's higher risk.
Sure. Is the source of mispricing behavioral uncertain about fundamentals, meaning creditworthiness measures? Any insights in this regard?
But that's an interesting thing. They have all that information, right? You have Richard, you have a lot of information from the borrowers. You have their addresses, their zip codes. You have their jobs. You have the income. You have all this information. So it's not necessarily, or for example, in this business loan, you have information on the collateral. You have all that information. You know how risky it is, and that's why it's interesting. Usually, in any bond, if there is collateral involved, you would have a lower rate of return because there's lower risk. Now, in this case, this isn't happening, right? Or usually when you're lending money for longer term, you would have a higher IRR. Now, in this case, that so it's sort of the opposite. And what we usually know about subordinated debt. So if you're not senior debt, then of course, if you're subordinated debt, you would have a higher IRR. But in this case, that isn't occurring. There's no pattern. And so it's very atypical. And that's why we found it interesting, because it would not normally happen in a normal debt. And it should be, because at the end of the day, it's still a debt. The borrowing is for the same reasons that you would do for a bond. You have all that information. It's not they don't have the information. It just seems that they're not using that information to price the security. But it could be because the investor may not be as smart or as concerned about it as a bond trader, right? So maybe that's it. We're not sure yet. We're still looking into that.
Well, Doctor, thank you so much for answering everybody's questions. I'm going to hand it back over to Amy.
Thanks so much, James, for moderating, and
Thank you
again for giving us this wonderful talk, and thanks to our audience for the questions that we mostly got to. I want to remind everyone again that the talk will be available on the CES website because it is being recorded, and there'll also be a little bit of additional information there for Dr. Johan's work. And just thanks to everyone, and have a wonderful evening.
Thank you for participating. Thank you for having me.
Our pleasure. Fill out that survey, everyone. Bye-bye.
Bye.